Hello and welcome to GoodGood Investing. My name is Rachel Grunn.
And I'm Andrea Cwik.
Welcome to another wonderful week of investing knowledge. We have done it all. We've seen it all. We don't know it all. But we
Getting
do
close every
know
day.
a lot. This is the trouble. We're getting closer, but then there's more stuff being invented. And so it's like
That's true.
the finish line is ever evolving and expanding.
But I love that. I love that we're constantly learning
Yeah.
and then we're sharing what we know
I know.
to our listeners.
It's mind-blowing, and there's like even things that I've learned in the past week that have blown my mind about investing, and I just feel like, I never want to be the smartest person in a room. I never am even close to that, just caveat. I also don't want to be the dumbest person in the room.
No, but like the rooms that we're in are mind blowing because it's like GoodGood Investing just celebrated our 1 year anniversary. And I feel like we're finally, getting some traction and people are knowing us and we're able to build closer relationships with people. And then we're invited into opportunities that no one really talks about or knows about, and
It's all
usually
relationships.
it's like saved for the ultra rich. And we're going to be talking about triple N today, which has been pretty much saved for the ultra rich. Like,
Yeah.
in order to get to a triple N deal, you need around $3 to $6 million.
They're not oftenly syndicated.
No, they're not.
The only other triple net I've ever known of that's been open for passive investors wasn't even a syndication, it was a fund.
Yes.
So investors didn't get a share in the depreciation on the asset.
Mm-hmm.
So this is super unique. I've actually never seen it done before, which is exciting. Not that triple net's ever been done before, but never seen it opened up to other people because, like you said, it's really been reserved for people that just have the cash to just front it themselves. It's
Exactly.
just an individual.
Yes.
So, but there's some things that we've learned on our triple net journey, which are very interesting and exciting. And what do we not do at GoodGood? We don't gatekeep.
We don't gatekeep.
So we're going to share with you guys all of those sort of back end discussions that we've had with people that are way more knowledgeable in this space than we are, and kind of peel back the curtain on triple net investing.
Yes, I love it. And I think I've said this before in other episodes, but I wish I would have known back then when I started real estate investing what I know now, because triple N to me is like one of the most risk resilient investments and assets. And if you're looking for cash flow and appreciation, this is definitely an episode to listen and re-listen to, because not a lot of people are even educating about this.
Yeah,
so,
no, they're really not.
So yeah, listen up.
This is like what multifamily was like 15 years ago.
Yes,
when
yeah.
no one knew that. Like now, it's like I feel like a lot of people know about
Yeah.
multifamily, but this is like the new thing. You guys need to get in now because soon enough it'll be oversaturated, I'm sure.
Yeah.
But right
Yeah.
now, it's like a really exciting time to invest in triple net. So a couple of things are like how the leases are negotiated, which is so interesting because quick refresh on triple net, it's just a special type of lease that we sign with our tenants, and it just means that the tenant pays for all of the insurance on the property taxes, all of the maintenance. I mean, pretty much every cost associated with the property, utilities, etc. So as building owners, we're not running the business. That's leasing from us, and we're also not paying any of the expenses on the property. So even as general partners, it's pretty passive, honestly.
Yeah.
We do a lot of work up front, obviously on the purchase, but aside from that, we just sit back and get the checks.
Okay, so I'll back up for a second. So we buy land, we buy the new builds that's almost already built out. Before the asset is done, before the physical commercial property is done, the broker goes out to select people that he already has a relationship with, and the broker is the selling agent. So there's builders that have come in, they've assessed what would be a good type of business, they've built it. The broker is now shopping it out to select people that already have a portfolio of properties. We go in and we're like, okay, so what is the plan for this? okay, there's land, there's this build that is almost done. They've already also identified the business that is going to go into that asset. And now we come in and we are ready to negotiate terms. And the triple N means that they've already, for us in this deal, it's a child care center. This business has already said that they don't need the owner to take care of anything, right? So there is no expenses from the owner side, from the building owner side, because the tenant, like Rachel said, in this case, the child care center, is going to take care of all expenses.
Everything.
Everything.
Yeah.
So when you look at a business, you're looking at the net operating income, and there's a lot of expenses that come with running a business. And sometimes, if you compare it to multifamily, there's a lot of expenses running an apartment building. But when you look at triple N, there is no expenses. There's only checks, like Rachel is saying. There is only cash flow that comes in because there's no expenses going out.
Yeah, exactly. It's pretty amazing. So when you're negotiating a lease, well, what are the terms? Well, essentially you're negotiating in escalation clauses, which means every X number of years we're increasing rent by X amount. In this case, it's every 5 years we're increasing rent by 10%. So that's how we negotiate that ahead of time, right?
And that's what's going to give us appreciation, because every time there's a rent bump, that increases the net operating income. And we know this, what is determined to, like, what we're going to sell the property for is what the NOI is in commercial real estate. So you need those rent bumps to give us a higher NOI, which then in turn gives us the appreciation.
Yeah, your NOI is your net operating income, and that's how commercial real estate's valued. And then also there's exciting things in there, like, okay, so is the business corporately owned or is it franchised? That's an important question. And generally, it's better to have a corporately owned location, just because when it's owned by corporate, it's just always runs smoother, just managed better. Not to say franchised locations aren't great triple net opportunities. Just make sure you do your due diligence on the franchisee owner, right? But this one that we're doing is corporately owned. But then we have to have a clause in there, like, what if at some point they want to convert it to a franchise and sell it to a franchisee? We negotiate a first right of refusal, where we can also vet the franchisee owner, or we can choose to franchise it ourselves and actually run the business ourselves. You would want to make sure you had experience in that business. Our partners do have experience in the childcare business, luckily, but at this point, it is corporately owned, and it has like 400 something locations nationwide, which is also important in triple net. You want to make sure that it's not like a mom and pop shop. It's like a legitimate business that has multiple hundreds of locations, has been in business for a long amount of time. And then also you want to make sure that there's a corporate rent guarantee as well. So we negotiate those as well. Will corporate step in and pay the rent if this location here is unable to for some reason?
It's unable to get the income that they expected so that they can make the mortgage payments.
Yes.
For
rent payments, not mortgage. They don't own
I'm
it.
sorry, yes, the rent payments. For this particular asset, what's mind-blowing is that we don't have any debt on it. I'm talking about our deal specifically at this time, but that just means that because there's no debt, that means that as building owners, we don't have to pay a mortgage. So all the income that comes in from the from the childcare business goes straight to the pockets of the owners. And when we are syndicating, it just means that when you invest into this, that money that comes in gets divided up to all of the investors.
Yep, exactly. I mean, the things we've learned about this in the past couple of weeks is like amazing, like totally incredible.
Well, I love just that it's risk resilient. I mean, it's like there is a business that it has a tried and true model. If they have over 450 locations nationwide, that means that they know what they're doing.
And our partner was also telling us like how she selects an area. the building has to face a roadway that has more than 50,000 vehicles per day.
Yes. I wouldn't have known that.
I would have never known that.
Yeah.
And we're telling you guys, we're not gatekeeping anything. Like,
Yeah.
we want you guys to have all the knowledge as well, so that when you invest in triple net lease, you know the questions to ask. How many vehicles per day go by the front of the location? If your syndicator doesn't know that, I'd be a little concerned.
Yeah.
They
Yeah.
should have done that due diligence ahead of time.
Yeah. So that, yeah, and then the location, what is crazy, like the location of this specific deal is in Southlake, Texas, but if you're looking at purchasing a triple N, location,
Yes.
and then road frontage,
Yes.
huge.
And traffic, huge. Like all times a day. Like, what's the traffic like on a weekend versus a weekday? Like, these are things that you should definitely know, and then average that and hit that 50,000 a day.
Yes.
If you really want that exposure.
Okay, so I know the answer to these questions, but for our listeners, so what if a pipe freezes at the location? What kind of responsibilities do the building owners need to have in that?
Well, obviously we need to know about it, but the tenant is the one that is the insurance policy holder. So the tenant would file with the insurance company that they chose, and file a claim and then pay the deductible, because they pay all expenses with the property.
Exactly.
Yeah.
Ding, ding, ding. There is pretty much no responsibility on the owner's side.
None.
So what happens if they need a new driveway, a new parking lot?
Again, that's on them. That's maintenance. That's expenses with the building.
And not all
Well, it also depends on if we own, if the parking lot is, if it's in like a office, like park, then it might not be the responsibility of the building owner, depending. But if in this case, in the building we're purchasing, it's standalone, and it does own like the whole ground, the whole parking lot. So that would be
Yeah. And there are some cases where a triple N might have the parking lot not included in the triple N part. Because I remember, I think Julie mentioned like the Starbucks deal that she did last time. That one we would have had to pay for the parking lot to get fixed. But it definitely is a good question. Mostly it's just the responsibility of the person or of the tenant that's leasing.
Yep. Literally, it's like amazing. And then you think, well, why wouldn't the company just buy the building too? There's a lot of reasons why they wouldn't. These people aren't real estate investors; they're business owners.
Yes.
So they, at the end of their lease, they would then be tasked with selling the building, brokering the building. That's a lot. And if they can't sell for whatever reason, or they struggle, or they don't know what they're doing, then that's just added risk for the company. They would rather know, okay, this is how much I'm paying every month in insurance, property tax, and then also our rent. So this is like our expected cost, blah, blah, blah. Money set aside for any incidentals, and then they can just like wash their hands of it at the end of their lease and move on.
Yes, exactly. And I think also some people just want to take care of their business and not really worry about the ins and outs of real estate. And also that might be like a little bit more on the accounting side. Sometimes the taxes increase, or they don't know the right deductions. There could be several reasons why they don't want to own the property itself. So for them, it's just like an easier transaction to just come in and rent.
And I've also learned that even if you sign a 20-year lease, it doesn't mean that you have to own the property for 20 years.
Yes.
You can sell it to someone else with that existing lease in place. They would just take over as the property owner. So fascinating stuff. So fascinating. We have so much more exciting stuff coming your way as well. We're going to keep sharing all of the secrets that no one else wants to share. I don't know why. That's like what we're all about, right? Is more knowledge. So stay tuned. If you want to get in touch with us, if you're interested in this triple net offering, at the moment of this recording, it's still available, but TBD on when it comes out. Get in touch with us. But again, you should anyway, because we might have another one of these soon. We don't know. GoodGoodInvesting.com. You can schedule a call with us there, and then we can keep you posted on all of the exciting things we have coming up.
Yeah, and then if you're looking to have us on your podcast, or you have a conference coming up, please get in touch with us. We're definitely open to sharing our knowledge on multiple stages as well.
That's right. You know where to find us. Well, until next week, don't invest good.
Invest twice as good.
Bye.